Have you noticed something interesting lately? Whenever people talk about artificial intelligence, names like NVIDIA, Microsoft, Google, and OpenAI dominate the conversation. Everyone wants to invest in the AI revolution, but most Indian investors think they have to buy expensive US stocks to benefit from this trend. But what if I told you that India has its own company that's quietly building the backbone of AI infrastructure? A company that's supplying high-performance computing systems, AI servers, and supercomputers right here in India. A company that's growing at an incredible pace while most investors are still unaware of its potential. That company is Netweb Technologies India Limited. Now before you rush to buy the stock, let's understand exactly what this company does, why institutional investors are interested in it, what risks you need to know, and finally whether this stock is suitable for long-term investing or whether it's actually a better opportunity for swing trading. So let's get started. First of all, what exactly does Netweb Technologies do? Unlike traditional IT companies that mainly provide software services, Netweb is a technology hardware company. It designs and manufactures high-performance computing systems, enterprise servers, AI servers, storage solutions, private cloud infrastructure, and supercomputers. Think about every major AI model being trained today. Those models don't run on ordinary computers. They require thousands of powerful GPUs connected together inside specialized servers. Building this infrastructure requires expertise that only a handful of companies possess. And that's where Netweb starts looking interesting. The company is one of the few Indian manufacturers working in the field of high-performance computing and AI infrastructure. One of the biggest reasons investors have become excited about Netweb is its collaboration with NVIDIA. As most of you already know, NVIDIA currently dominates the global chip industry. Whenever companies need powerful GPU clusters for AI workloads, NVIDIA hardware is usually involved. Netweb has built an architectural collaboration with NVIDIA, allowing it to develop advanced AI infrastructure for enterprises, research organizations, educational institutions, government agencies, and data centers. As artificial intelligence adoption continues growing across industries, demand for this type of infrastructure is expected to increase significantly. And that's one of the biggest reasons investors believe Netweb could benefit from the AI revolution. Now let's talk about the numbers. Because at the end of the day, great stories are only valuable if the financial performance supports them. And in Netweb's case, the financial performance has been exceptional. One of the biggest highlights is the company's AI systems business. This particular segment has grown by an incredible 459% year-over-year. Just think about that for a moment. A business segment growing nearly 5 times within a year is something you don't see very often. Even more interesting is that AI systems now contribute more than 43% of the company's overall business. That tells us AI is no longer just a future opportunity. It is already becoming one of Netweb's biggest revenue drivers. Now let's look at the company's overall revenue. Netweb reported revenue of approximately 2,183 crore rupees, representing an impressive 90% growth compared to the previous year. Very few listed companies are currently growing their top line at this speed. But revenue growth alone isn't enough. Many companies increase sales while profits remain weak. Fortunately, Netweb is also delivering strong profit growth. The company's net profit increased by 81%, reaching around 205 crore rupees. That means both revenue and profitability are moving in the right direction simultaneously. And things become even more interesting when we look at the latest quarterly results. The company's quarterly profit surged by an incredible 179.9% compared to the same quarter last year. That's not just growth. That's acceleration. It suggests that demand for the company's products continues to strengthen. Now let's examine how efficiently management is running the business. One of my favorite financial ratios is return on capital employed, also known as ROCE. This ratio tells us how efficiently a company uses its capital to generate profits. Netweb's ROCE stands at approximately 37.5%. Anything above 20% is generally considered excellent. A ROCE above 35% shows outstanding operational efficiency. The next ratio is return on equity, or ROE. This measures how effectively management generates profits using shareholders' money. Netweb's ROE is around 32.8%. Again, that's an excellent figure and indicates the company is creating substantial value for its shareholders. Another thing I always check before considering any investment is debt. Many fast-growing companies rely heavily on loans to expand their business. While debt can accelerate growth, it also increases financial risk. Netweb is different. The company has a debt-to-equity ratio of 0. That's right. It is completely debt-free. A debt-free balance sheet gives management much greater financial flexibility during uncertain economic conditions. It also reduces interest costs and allows more cash to be reinvested into future growth. Now, after hearing all these positive numbers, you might be thinking this sounds like the perfect investment. Strong revenue growth. Strong profit growth. High ROE. High ROCE. Debt-free balance sheet. Boom. NVIDIA collaboration. So what's the catch? Well, every great company doesn't automatically become a great investment. And that's where valuation comes into the picture. The market already knows that Netweb is an outstanding business. Because of this optimism, investors have pushed the stock price significantly higher. Today, Netweb trades at a price-to-earnings ratio of roughly 98 times earnings. It also trades at a price-to-book ratio above 35. Now let's understand what this means. When investors are willing to pay 98 rupees for every 1 rupee of earnings, they're expecting years of exceptional growth ahead. The valuation already assumes the company will continue executing almost perfectly. And that's where the biggest risk lies. If revenue growth slows down even slightly, if AI spending temporarily weakens, if there are delays in receiving high-end chips, if supply chain issues affect deliveries, or if margins decline unexpectedly, the stock could experience sharp corrections. That's not because the company becomes bad. It's because expectations are extremely high. This is something many new investors ignore. A fantastic business can still become a poor investment if you pay too much for it. That's why valuation matters. Now let's talk about something that makes Netweb particularly attractive, not necessarily as a long-term investment at current prices, but as a swing trading opportunity. Recently, the stock witnessed a significant breakout supported by exceptionally strong trading volume. More than 45 lakh shares changed hands during the breakout session. That's a very important signal. Large trading volumes usually indicate institutional participation. Mutual funds, foreign investors, and large institutions often leave footprints through unusually high volumes. Now let's look at the technical picture. The stock is currently trading comfortably above both its 50-day moving average and 200-day moving average. This indicates that the long-term trend remains bullish. Before the breakout, the stock pulled back toward its 20-day moving average. Instead of breaking down, buyers stepped in aggressively. The very next session, the stock witnessed powerful buying pressure and moved sharply higher. Even more impressive was the closing price. The stock gained nearly 8% in a single trading session and closed very close to the day's highest level. Why is that important? Because when a stock closes near its day's high after a strong rally, it tells us buyers remained in control until the market close. There wasn't significant profit booking. That's generally considered a bullish signal. For swing traders, this combination is attractive. Strong fundamentals, powerful institutional participation, bullish price structure, high trading volume, and positive momentum. Many experienced swing traders prefer stocks exactly like this because they combine business quality with technical strength. Instead of holding an expensive valuation stock for several years and worrying about future corrections, swing traders attempt to capture shorter-term price movements. If momentum continues, they participate in the upside. If momentum weakens, they exit with disciplined stop losses. Of course, no strategy guarantees profits. Every trade carries risk. That's why risk management is always more important than predicting the future. So what's my overall opinion? I genuinely believe Netweb Technologies is one of the strongest AI-focused businesses listed in the Indian market today. The company's financial performance is outstanding. Its management appears to be executing well. Its balance sheet is exceptionally strong. And the AI opportunity is real. However, the valuation leaves very little room for mistakes. That's why investors need to be cautious rather than emotional. For long-term investors, waiting for a better valuation or accumulating gradually may be a wiser approach. For momentum traders and swing traders, however, Netweb currently presents a very interesting setup because both the fundamentals and technical indicators are aligned. Now I'd like to hear your opinion. Do you think Netweb Technologies can become one of India's biggest AI multibaggers over the next 5 to 10 years? Or do you believe the current valuation has already priced in most of the future growth? Share your thoughts in the comments below. If you enjoyed this analysis and would like more deep dive videos on Indian stocks, US stocks, multibagger opportunities, swing trading setups, and long-term investing strategies, don't forget to like this video, subscribe to Retailgopro, and turn on notifications so you never miss an update. Thank you so much for watching. I'll see you in the next video.